You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everybody. Welcome to this episode of the Capital Table. This is Steve Brady, the market leader for transaction advisory with Withum. And as we continue to explore issues in M&A affecting private equity and other acquirers, really excited today that we are going to talk about cyber insurance and how this is impacting deals. And excited to have Joe Ehrlich and John Kearns, our friends with Brown & Brown, join us to talk about and give their insights into the market. Welcome, Joe. Welcome, John.
Steve,
thank you for having us.
Thanks so much for having us.
Yeah, great to have you here. And maybe if you can talk a little bit about your roles at Brown & Brown, and then we'll dive into this topic.
Thanks, Steve. I'm an executive managing director with Brown & Brown Risk Solutions, and I lead our cyber practice. I have about 36 years in the insurance industry and really have been involved with technology E&O that then morphed into e-commerce, which then eventually became the cyber insurance market.
Interesting. Joe?
Joe Ehrlich here. I am also at Brown & Brown Risk Solutions along with John. I run our transactional insurance group, which is part of our larger private equity group. We focus in the transactional risks group on reps and warranties insurance, tax insurance, litigation insurance, a lot of these types of insurance. What's relevant for today is reps and warranties insurance and how it interacts with the cyber. I come from a legal background where I was an M&A attorney during the first years of my career, and then for the last 20 have been focused on transactional risk.
Great. Well, welcome to both of you. And again, excited to talk about this topic. Yeah, so there's always risks in any M&A transaction, and certainly those lists of risks seem to keep growing. But from your viewpoint, are cyber risks a major concern when contemplating an M&A or other important deal?
Yeah, thank you, Steve. Yes, unfortunately, they are. Well, so the theory goes, and I do not have any empirical data to support this. So I'll just put that out there, although I have been looking for it. But, companies that are contemplating selling their business, they want to get the highest valuation, highest multiple they possibly can, most likely. And so are they starting to maybe think about where they're investing money and where they're spending money, reducing expenses to increase that bottom line EBITDA to drive the highest multiple? And, that's probably going to involve the cybersecurity maturity. So most companies are looking at, cybersecurity as a continuum. You are always looking for where do we want to be in comparison to the various standards that are out there. New York Department of Financial Services, NIST, if you're in healthcare, HIPAA. But this is a, continual investment, and it can be sizable. So a company that's thinking about, possibly it's a private equity company thinking about an exit strategy. It's a private business where the ownership structure is going to change. There may not be any, successors, but a company's really thinking about putting themselves up for sale. We're probably going to see some trimming on the expense line. We've seen this in public deals, very large public deals. I will not name any of those companies, but we've also seen it in private deals as well, where after closing, and mind you, there's been due diligence done prior to the close. In some cases, we've seen where there's been malware that's been implanted into a company's network, but it really wasn't discovered until sometime after the closing. So in some cases, this has been where it's discovered weeks after closing, in some cases, months after closing. But the malware and This could be a ransomware event. So the kill switch is hit. The company discovers that it can no longer operate, and nefarious actor is making a demand. These things happen even with the best due diligence that takes place prior to the close or through the whole valuation process. But it's problematic when we're seeing companies going through transactions and there's a surprise somewhere down the line after you've already structured the deal and the liabilities, the price, and there's little to no recourse after that. So it's both in the large public sector. We've seen, multi-million-dollar type of loss events due to a cyber issue that was not discovered until after the deal closed. So yeah, to answer the question, it is a problem.
What are some of the things that purchasers and sellers should be thinking about, as they're marching towards closing to help mitigate these risks? You mentioned due diligence, obviously, hopefully we'll locate some of these risks, but, what other things should they be thinking about?
Yeah. And, a number of companies they'll outsource the due diligence. So they'll have a managed security provider actually go into the network of the target company or asset lease validation, certain controls. They'll test some of those controls. But assuming you get through the due diligence and all looks good, still anything can happen. So 9 times out of 10, if you're in a situation where you're purchasing an entire company, hopefully they have cyber insurance. That's usually a good sign that the control environment is at a certain standard. And if that company is going to be acquired 100%, then that cyber insurance policy that they purchase will likely go into what we call runoff. And what I mean by that is that there's a provision in the insurance policy. It's a change in control provision, which the company is more than 50% of its right to vote, or more than 50% of its stock is being acquired. Then the policy will, at the time of closing, will no longer provide cyber insurance for any type of events that may have taken place up until the closing. So if you had a cyber insurance policies with renewal dates of January 1 to January 1 and the deal closed in June, you would have 6 months of the insurance after the closing, but only for acts that had taken place prior to that June event. So that's the change in control. And now you've got 6 months of what we call discovery. So that runoff policy now becomes a place to go to if there is anything discovered after the closing, as long as the event took place at that target company prior to the closing date. Now, what we recommend is that you purchase about 2 years, which is roughly just a little too much of the average time it takes to discover a cyber event. Last statistic I read, it was about 200 days after a ransomware was deposited for it to be discovered. So these things are going on well before a company is maybe even contemplating selling itself. So, but in that case, having 2 years of discovery or putting that policy into runoff for a 2-year period, that's a very good thing to do. I would also say that if the purchasing company, the acquirer, also has a cyber insurance policy, is that you may want to structure it so your own policy goes excess of that runoff policy or that discovery period, so that you get even more insurance, and that would be providing prior acts excess of the runoff policy. And I point that out as well because in a lot of cases, we'll see, first of all these cyber insurance policies are all very, very different. There's nearly 50 retail cyber insurance carriers across the globe. They all have different forms. They all have different definitions. They all have different exclusions. Some of them have sublimits for certain coverage. Others won't be able to provide you certain coverage extensions, such as business interruption or contingent business interruption, or if you read any of the articles surrounding CrowdStrike, what we call systems failure. So, the runoff policy is as good as the language that's in it. So to have your own policy go excess of it also gives you an opportunity to structure what we would call a difference in conditions, where if the underlying runoff policy isn't broad enough to cover an event that may have been discovered after the close, that your own policy could actually act as primary and respond to that claim. So there's different ways to look at it, but I think as you're getting towards a closure date, one thing I would certainly impress upon anyone is to have someone that is a cyber insurance professional that is in the market every day and knows really the efficacy of the coverage that's not only in the current policy, but how to build any limitations that may be found so that you can get the strongest, most comprehensive coverage in the event a claim were to happen.
Yeah, interesting. And interesting, the major concerns that can arise, for a cyber incident prior to closing and not discovered until after. I know certainly we've seen various things in our cyber practice and our transaction practice. So, yeah, thanks for covering that, John, on, how comprehensive cyber insurance can be a solution. So in addition to comprehensive cyber insurance, John, how does cyber tail insurance intersect with RWI? And obviously, Joe, with your group on the RWI side.
So cyber insurance and reps and warranties in insurance work together very well. They are not exactly the same. The reps and warranties coverage is triggered off of the representation in the purchase agreement. That representation is going to be a product of negotiation between the buyer and seller. It serves a disclosure purpose as well as the purpose of indemnification. So part of what that rep is seeking to do is to get information about the company, about its systems, about any events that it is aware of. Often certain provisions will be qualified by knowledge. So what is a breach of the rep and what is a claim under a cyber policy may not always be coterminous. As a result, the interplay between them can be that they act independently or that they act in concert. Often they will act in concert, where something that is a breach under the reps and warranties insurance will also be a cognizable claim under the cyber policy. In that case, the way that we usually structure the reps policy is that the reps policy will not wait for a resolution of the cyber policy. Whichever claim is resolved first is the claim that gets resolved and paid first. However, in that event where the reps policy would pay out, and it is also a claim under the cyber policy, the reps carrier would seek to subrogate, in other words, to recover its money back from the cyber policy.
Yeah, and I would add on this, Joe, you and I were just talking about this a couple of days ago. If it's a public company and there's reps and warranties being made, it's likely the reps and warranties are going to end at closing, meaning that the acquirer is taking all the liabilities with it. But, in the event that something's discovered prior to close and you do have a rep and warranty policy, it may not kill the deal, but we certainly have seen deals having to be dramatically repriced. And as Joe mentioned, Steve, you're going to look at the cyber policy first, and that would be the company that's being acquired would want to make a claim. If there's any recoveries made under the policy subsequent to closing, you'd want to make sure that the acquiring company is the beneficiary of it. but you may be able to get into some of the rep and warranty type of language. And certainly if it's not a public company and the reps and warranties continue past closing, your cyber policy, again, that runoff policy I was talking about earlier, that's going to be your home to really try to get some recovery. But you could be looking at the rep and warranty insurance to be providing some additional coverage around that too, depending on how the reps are structured.
What John is talking about is a really interesting phenomenon, whether in the context of a public company transaction or not. And that is what happens if the representation was true, if the cyber event wasn't known when the transaction was signed. And yet there is an interim period, a period of time where they may be getting third-party consents, regulatory approvals, HSR approval, and the like. What happens if during that period of time you discover a cyber breach? What are your recourses? And the question is really going to be, what is the magnitude of that breach? Most transactions have the concept of an MAC or an MAE, material adverse change, material adverse effect. And the idea of that is, hey, if something happens and it is so large and so calamitous that it really changes the nature of the transaction, then I should have the right to walk away. In fact, what that often does is it gives a right to renegotiate the transaction. I could walk away, and if you're still going to make me pay $2 billion or $4 billion or whatever the purchase price is, I will walk away from this transaction. But maybe we could negotiate. Maybe we could come up with a lesser purchase price. Now the question, what if that loss isn't large enough to constitute an MAE? What if it is significant, but not that significant that it doesn't give rise to a right to walk away? Well, this is a place where reps and warranties policy can be very valuable. What we typically advise our clients to do is to put the representations and warranty policy into place at the time of the signing, and then it binds and becomes effective at the time of the closing. So if an event is discovered during that interim period, and it relates to the period prior to signing, so it's not a breach that happens and is discovered immediately, but it's one of these latent types of breaches where the groundwork had been laid by the cyber criminals prior to the signing of the transaction, and yet we discover it during that interim period. Reps and warranties actually allows for that to be a claim. So essentially what happens is you close the transaction, you have that change of control, and then you immediately have a claim under the reps policy. Again, provided that it winds up being a breach of the rep. So it actually provides additional coverage. And the other thing related to this that John was talking about is the idea that in a public company context, the representations and warranties typically die at closing. The idea is that there's so much publicly available information about publicly traded companies that you don't need the protection of the reps and warranties in the same way that you would in a private transaction. So when you get to closing, any indemnification obligation by the seller goes away. If you have reps and warranties insurance, you can actually buy your way out of that situation. In other words, by buying the policy, you'll get that indemnification from the insurance company where you're not able to get it from the seller.
Yeah, it's interesting. And related as we work with our clients looking at acquisitions, and oftentimes bring up the capabilities of a cyber consulting practice that can come in and assess these risks. And oftentimes, and this discussion is really fascinating for me, pointing out these risks of an event before closing that becomes to light afterwards. And it seems, certainly from our anecdotal experience, a lot of clients are just worried about if something's happened that they know of. But my point is, and question is, with these dynamics that you guys are talking about, I mean, what's the importance of cyber diligence during the due diligence phase from the lens of your RWI insurer? And, how and what are they going to look at in terms of making sure that an acquirer's done their due diligence in cyber and other, related risks?
Yeah, due diligence, it's really critical, Steve. For companies that are acquisitive, and we have plenty of clients that are, the cyber insurance underwriters, they want to know the extent of the due diligence that's being done. Was there any penetration testing? What's the control environment look like? Is there endpoint detection and response, MFA, segregated networks? It should be, in terms of the due diligence that's done on a target company. And again, a number of clients outsource that due diligence to, well-known and respected managed security providers. It can be, very material. And like I said earlier, we've seen some deals repriced. The cyber event was discovered prior to closing, so they have that ability, thankfully. But in other cases, we've seen the event manifest itself into a claim, into a financial loss after the closing. And in some cases, the cyber insurance that was purchased by the acquired company that's now into runoff wasn't adequate. So it's not only the due diligence that's important, but it's also knowing, what size of claim could a company possibly even incur if they were to have a cyber event. So quantifying it. So if that acquired company did have a cyber insurance policy and they are going to put it into runoff, so that's now the home for any claim that might be discovered after the closing date, how adequate is it? One I mentioned earlier as respects to the coverage, but also as respects to the limits. So again, companies that are thinking about putting themselves up for sale, they may not be buying the most, amount of cyber insurance that they could be buying or the appropriate amount. So the due diligence, understanding that the control environment is at high standards, that they have cyber insurance, but also quantifying the cyber risk and making sure that whatever insurance may be drawn upon, that it's adequate, both from a coverage standpoint, but also a limit standpoint.
Yeah, that's great. So I guess let's switch gears just slightly, still talking about reps and warranties, but what is the current state of the market for RWI when it comes to coverage for cyber risks and, things like how willing are carriers to cover these risks and do they look at certain cyber risks differently than others?
To chime in on what John was saying about due diligence is also critically important to the insurer, the reps and warranties insurer. And it really serves two significant functions for them. The first is that since reps and warranties underwriters are not typically experts in the cyber field, they want to make sure that somebody competent is looking at it. In other words, as part of their underwriting process, they're going to be relying on the fact that the company has brought in competent professionals that understand cyber risk and are looking at these issues. That gives them a lot more confidence that they are going to get it right. And then the second, of course, is that through that process, they hope to reveal any issues that might arise. For example, a known issue that may lead to an exclusion under the cyber policy, or a known area where the company is not conducting itself in accordance with industry norms, where their protections of this critical data is subpar compared to its competitors. So diligence, again, is a really critical place, just as it is with the cyber insurance.
Thank you, Joe and John. Appreciate that discussion on topics relevant in cyber insurance for our audience. Look forward to continuing the dialogue on a future episode of the Capital Table. So, to our audience, thank you for joining in, and we look forward to talking with Joe and John again on a future episode.
You've been listening to the Capital Table. For more information, please visit withum.com. Thank you for listening.